Okay, well, welcome to everybody, and welcome to our webinar this morning, which is all about avoiding the pitfalls of business ownership. Now, if you're here and you're running a business, I'm sure you'll be familiar with what many of those pitfalls are. What we're going to be discussing today is some of the pitfalls that relate, obviously, to tax and accounting. And we're joined today by Stuart, Peter and Christopher, all directors here at Thomas Coombs. Welcome to you all. And the idea of our session this morning is to cover some of the most frequently asked questions that we see being given to us by business owners, and we'll try and pick some of those up as we go along. We do want to make this an interactive session, so we're happy to take questions. We can take them as we go along, or we can leave them till the end. I would suggest if you want to put a question forward on your Zoom toolbar, you'll see the Q&A option. Just click on that, and that enables you to put questions forward, and we will try and deal with as many of those before we get to the end of the webinar, which is scheduled to run for about 45 minutes this morning. We are also recording this webinar, so we'll make an on-demand version available on our website and social media channels after the event. So if you do need to recap on anything, you're able to pick up the recording on any of those channels. Okay, let's get started. And where I want to kick off is probably the most common question that we're asked on a very regular basis by new entrepreneurs, business owners generally, especially as tax rules change. And that's whether to take salary or whether to take dividends or whether to take a combination of both, and what's the most tax efficient way to take profits out of the business. So let's pitch that as our first question, and I'm going to direct that one over to Stuart. So welcome, Stuart, and I will leave you to answer this one.
Good morning. Thanks, Joe, for the introduction. Morning and welcome to everybody who's tuned in. For the record, this is my first webinar, so go with it as best you can. Yes, this is a question that we are asked regularly by potential clients, people who want to set up in business. Everybody thinks that is the way to go forward. We want to create a company. What do I do, Stuart? Do I go dividend or salary? So I thought to start with, I would look at what actually is a salary, what is a dividend, just to make it ultra clear to everybody. So a salary would normally be where you are an employee. You will have PAYE deducted, you'll have employers' national insurance deducted, and the company will have to pay employers' national insurance. So there are quite a lot of associated costs with somebody who is on a salary under the PAYE regime. Of course, if you paid a salary, then the company will get a tax deduction against its taxable profits for all those costs. So we have to bear that in mind, and it is more relevant now because there is an imminent change in corporation tax rates in the next few years. A further complication to salary is auto-enrollment or pension contributions. And again, depending on the level of salary, you may have to disenroll from the auto-enrollment and make alternative arrangements for pension contributions. If we turn now to dividends, dividends tend to be paid to shareholders. So in the same way that you and I may own shares in BT or Vodafone, etc., we are shareholders, but we are not employees and we are not directors. Dividends are paid from profits of the company. So the important thing is the company needs to accumulate profits or earn profits to enable dividends to be paid. There is a certain pecking order, of course. A company makes a profit. Sadly, the taxman has first dibs, and then what is left is available, excuse me, to shareholders. So it's that bottom line. After everybody else has been paid, there's a distribution available for shareholders. The most common approach for shareholdings will be ordinary voting shares, which will be issued depending on the percentage of ownership. So it could be 50-50 if you are in business with a pal, or it could be 90-10 if you're in business with somebody else who isn't as active in the company. However, there are also different options for shareholding in terms of A ordinary shares, B ordinary shares, there are also non-voting shares. And these allow a little bit more tax planning to be done, where people such as shareholders have different levels of income. So it's very flexible and it gives you a lot of opportunities to do a lot of tax planning. Shareholders can also be companies and trusts. That's topic for another day, for another webinar, if you can put up with me for another one. So we're back to salaries versus dividends. And as Joe alluded to, the most common approach these days is for people to have a mix of both. They'll have a small salary and the rest is then taken in dividends. The small salary is normally around £737 a month. That means no tax is paid, no national insurance is paid. However, the important thing from a national insurance point of view is that you still get a full credit for state pension, even though you're not making payments in national insurance. So a lot of people worry about, have they lost out on the entitlement? In reality, there is a credit going through for their state pension. Some people also pay a salary up to their single person's allowance, which is the tax-free amount that you are allowed to earn each year, of around about £12,500. In that case, you wouldn't pay tax, but you would be paying national insurance. So there's a slight hit on the national insurance front. So it's a mix of both. The key things to remember are, under PAYE, you'll be paying tax at 20% as a basic rate taxpayer, 40% as a higher rate, and 45% as an additional rate taxpayer. For a dividend, it is somewhat lower, and this is where the attraction is. For a basic rate dividend, it's 7.5%. It then goes up to 32.5%, and then it goes up to 38%, 38.1% if you're an additional rate taxpayer. So you can see those rates are lower, but as I said at the outset, you have to remember that corporation tax relief is not granted on the dividends because those are after tax, whereas your salary and your employer's national insurance is taken off at tax rates and getting a tax relief at the corporation tax rates. You need to bear in mind that from the 1st of April next year, Dishi Rishi has announced the increase in dividend tax by 1.25%. So those rates have now gone up to 8.75, 33.75 and 39.35. So the rates are still lower. We have done some calculations. We have looked at various scenarios, and like a lot of situations, it depends on personal circumstances and the way that your business is set up and the arrangements you have with your fellow shareholders, possibly also other business owners. So there isn't always a straightforward answer. That is accountancy, that is tax planning. But the general consensus right now is it is still slightly more tax advantageous to take out a dividend rather than a salary. So it's the mix of low salary and dividends, and that will continue to be the case. For most of our clients, we monitor these on a regular basis to make sure that that still is the case, and even allowing for the increase in the corporation tax rate next 2 years from now, then it's still advantageous, but it's marginal. So Rishi is starting to erode the advantage. If you want to take advantage of it now is the time to do so. A couple of things to bear in mind when you're thinking about dividends, and one of them is at the forefront of most people's mind. Everybody that was on small salary and dividend in March 20 got a wake-up call because furlough didn't give them anything. So there is a pitfall there. I'd like to think that will not be repeated, but who knows what's around the corner. Other things to bear in mind, most mortgage companies or banks, building societies will accept dividends as a source of income because they rely on an income per a tax return. There are other issues like maternity pay, parental leave, etc. Benefits, they may be affected if your structure of your income is more towards dividend than salary. So again, It's a matter of sitting down with us, explaining to us what your position is. We can then work out what the best way forward so that you end up with the most tax efficient way of extracting money from your business. So sadly, it depends on your circumstances, but we'd be happy to sit and talk to anybody who's got some questions or has got plans that they want to make. As I say, the next few years will be crucial because of the change in tax rates going forward. So that's all I wanted to say on dividends versus salary. If anybody's got any questions or any comments, please let me know.
Great, thanks very much, Stuart. Okay, well, if you've got any questions relating to that, put them in the Q&A and we'll come back to them at the end. Because what I want to do now is move on to our second most common question, which is, should I have a company car, and what's the most tax efficient way to run a car through the business? And I guess we can probably touch on electric vehicles as part of this question as well, which I'm going to aim over to Christopher. So over to you on this one, please, Chris.
Thank you very much, and good morning, everybody. Now, as Joe says, the business owner is very likely to want to buy a car, and nowadays that's very much electric cars on the agenda. Now, that business owner could have the car very simply by using those dividends and salaries which Stuart's mentioned to buy a car personally, incur all the costs out of their own bank account, and that's a simple solution. There is a slight upside in that if you're using the vehicle for business, you can claim 45 pence per business mile the first 10,000 miles, and then 25 pence after that. But an alternative would be for the business to pay for the car and provide to the individual instead of those salaries and dividends. And to understand whether that's worthwhile, it's worth investigating the tax structure behind that provision. Firstly, the company would pay for all the costs. It would actually buy the car or lease the car, incur all the running costs, insurance, repairs, and so on. It might even be able to recover VAT if it's VAT registered on the leasing cost, where it can get 50% of it back. And the company will get tax relief on all those expenses. So that's all good news. The person who's been provided with the car, the business owner, would pay none of those costs because the company's already covered it. But the sting in the tail is that the revenue would assess that individual for benefit in kind being provided with the company car. And on that assessment, the individual will pay income tax, on their marginal rate, might be 20% or 40% or 45%. Now, that benefit in kind is made up of two elements. There's the car benefit, the actual provision of the car, and that's based on a calculation based on the list price, and then multiplied by a percentage. And that percentage is very much driven by CO2 emissions of the vehicle. And that calculation, for example, a list price might be 40,000 for a typical car nowadays. If the CO2 emissions were 80 to 84 grams per kilometre, the percentage applied would be 20%. So it'd be a benefit in kind on that car of £8,000 a year. Now, I mentioned 20%. Those rates can range from 15 up to 37%, just depending on how much that CO2 emissions are. The other element would be fuel. So if the company actually pays for the fuel as well, and that's provided for private use, there will be an extra fuel benefit in kind. And again, that's based on the CO2 emissions applied to a set basis figure. So the summary of that is the higher the emissions, the more expensive those benefits in kind get. So the result of that over the last few years is that in many cases, a company car is not very tax efficient, because although there's tax relief from the company, the benefit in kind and the tax paid by the individual can be quite hefty. We've got examples with fuel benefits where the actual tax on the fuel benefit is actually more than what's actually spent on the fuel. It gets that expensive. So there's been a trend for provision of private cars. Now, that's dramatically changed in very recent years with the climate change agenda and the tax incentives provided for the provision of electric cars. And how that impacts the decision whether to provide a company car or a personal one is that, just like my previous example where companies providing the car, all the costs can still go for the company. and the company will get tax relief for those. But what's dramatically changed is on the car benefit assessment, and they're dramatically down. For example, in the last tax year for 2021, for an electric car, that percentage applied to the list price was 0. So the individual would have no benefit in kind. And that even applied to the hybrid cars, where we've got a very long range for using the electric element of more than 130 miles. And that was 0 last tax year. Now they are increasing slightly. So the current year it's 1%. And for the next 3 years after that, it will be 2%. But they're very small rates. And it means when you look at the combination of the tax relief in the company and the tax paid by the individual, there's very much a swing towards the tax efficiency of providing a company car, if it's an electric vehicle or a hybrid vehicle with a high electric range. Mentioned hybrids. If that electric range gets shorter, it's treated more like a conventional car, so those percentages applied to benefit in kind get higher. But even at the very inefficient hybrids, where they can only do 30 miles or less, that rate is only 14% next tax year, so it's still quite fairly efficient. Another massive incentive for the electric vehicles is that I mentioned fuel benefit earlier. There is no fuel benefit for electric cars. The provision of electric is not assessed as fuel, so there's no benefit kind charged on the individual. So there's all these factors driving the calculation towards beneficial to have an electric company car. Now, there's a few other extras to throw into that. The home charging points, which you need for running an electric car. If a company wants to install that at an employee's home and it's used to charge a company car, there's no benefit kind on that. From a company's perspective, if they buy an electric car, they can get 100% first year allowances, so they can write that off straight against their profits. Now, if it comes to start in later years, it might be a taxable profit then, but initially, first year allowances, so that's very good for cash flow. And even installing the electric charging points, you can claim 100% first year allowances on those as well until 2023. So it's quite a shift in the impact of for the benefit in kind calculations, impact the provision of cars and the electric cars. This low benefit in kind throws up some other tax planning points for a business owner. They might want to have a second car, maybe provide to a child. That would still be assessed on them, but because of the low benefits in kind, there's some good tax advantages to be obtained there. Now, I've thrown a lot of things at you there. How Thomas Coombs can help with this is we can do a car review for our clients, and we can actually plug through these numbers and work out what's the most tax efficient, whether it's a conventional car we're looking at, because there still are cases where a company car could be beneficial to be put through the company, or we can reassure you that a private car is the best option. We've got a computer model where we can look at all these costs and even look at the salary negotiations if you're wanting to switch an employee from a company car to a private car and vice versa even. And Stuart mentioned the salaries and dividends. We can actually pull it all together and just see how much profit you need to generate, and if you're putting money out as dividends or salary, what the overall use of those profits is to provide a car. So it's some very interesting figures there. So that's where I want to complete my section. So I think the summary is, boiling it down to a very summary level, company cars were waning in recent years, but the electric option and how the government is giving the tax incentives is giving a real boost to having electric cars provided through the company. All right. Well,
okay.
Thank you very much for listening.
Thanks very much, Christopher. There is a question actually that's come in relating to your slot from Hayden. Thanks, Hayden. How do you deal with the cost of charging at home for an employee? Is that charged back to the company? So that's charging their company car at home.
Yeah. So if you're charging it at home, you're using electric. The government allow you a tax-free allowance of 4p per business mile for actually charging the car and using it for business. So you can put that through just like an expense claim back to the company and be reimbursed for that.
Lovely. Okay, I hope that answers your question, Hayden. If you've got any more, put them through on the Q&A. Okay, we'll move on from company cars at this point to talk about something slightly different, which is what is a director's loan account. So if you're a bit like me, when you get the final accounts at the end of the year, I do try to fathom this out and never quite understand it. So I'm hoping Peter will shed some light on what is a director's loan account, and perhaps more importantly, what does it mean when it's overdrawn? So over to you, Peter.
Yeah, thanks, Joe. And again, welcome everybody this morning. So the director's loan account is, in essence, is a method of keeping track of transactions between the directors and the company itself. So it's used to keep a record of money in and out of the business, which is not what Stuart's discussed this morning, the salaries and dividends, and not like business expenses that have been repaid. So it's any kind of expenses that the company may have made on your behalf, things such as that. But also it also tracks money that directors may have lent to the company for the company to use to buy plant and machinery or to use as working capital and things like that. So it can go both ways. It can be where the loan account is, the loan is from the directors, or it's from the company to the directors. So the director's loan account itself should record any cash withdrawals and repayments that's made from you as a director, any personal expenses that are paid by the company, as I've just said, and any interest that's charged on those loans also. Joe just touched on earlier on, a director's loan account can be overdrawn. That would occur where you have taken out more money than what you have put back in. An overdrawn loan account will be shown as an asset on the balance sheet of the company, where effectively you as a director owe the money back to the company. Those overdrawn loan accounts, if they are less than £10,000, can be interest free. But for loans that are more than £10,000, there should be interest charged on that at the HMRC's official rate. The current official rate for the director's loan account is 2%, so that the company should charge 2% interest. If that interest is not charged, and there's no interest charged on the director's loan account, and the loan is over £10,000, then, as Chris mentioned earlier on with the company cars and things, then it becomes a benefit in kind. And then the individual will be taxed on that benefit. Also to consider with an overdrawn loan account is if an overdrawn loan account is not repaid within 9 months of the year end of the company, then the company will be liable to Section 455 tax. The current rate of Section 455 tax is 32.5%. But that will be going up on the 6th of April 2022 to 33.75%. This Section 445 tax is a tax that's payable by the company. Once the director's loan account is repaid, that tax will be recoverable by the company. So although there is a tax there, if it's not repaid within 9 months, you can then get that money back. The company can get that tax back once the director's loan account is repaid. So in essence, that's what the director's loan account is. It's a way of tracking the transactions between the company and the directors, and keeping a log of what the balance, if it's owed to the director, or if it's owed to the company, and the interest on those as well.
Okay, thanks, Peter. That has explained it. I shall no longer look at it in confusion on my set of accounts. Right, we do have a bit of time actually for some questions, and we've got a three or four questions here. So let's try and answer these if we can before we finish the webinar. First one in is from John. I'm going to direct this one at Stuart. John's asking, Stuart, can you explain what an asset register is?
Yeah, now I've unmuted myself. Yes, I shall try. Yeah, an asset register is a very good document. It's a very good schedule to have, because it basically identifies all the assets that the company owns. It should detail the date of purchase, a brief description of what it is and how much it cost. You'll then have a calculation of the depreciation that's been applied, and then you'll have the final column will be the net book value. And the net book value, like all assets are in the accounts at the rate that the business decide they want to depreciate their assets. So, for example, somebody buys a car, they'll probably depreciate it normally over the term of a lease, 3 or 4 years. Somebody buys JCB, then they might want to depreciate that over a slightly longer period of time because they tend not to depreciate as much. And in some cases, plant and machinery can actually be sold for almost what they paid for it. So the fixed asset register will keep a tab on how much you paid for it and how much you have depreciated the asset and what it is in the books at from an accounting point of view. That doesn't necessarily reflect the market value because things change from one year to the next. So if that is correctly updated on a regular basis, there is a register of all the assets that the company owns and what they are in their books at. And one thing that I did find years and years ago was the fixed asset register was asked by the insurance company after a client had had a fire and the client hadn't kept a fixed asset register, and we did, and they were very grateful because it identified quite detailed notes of all the assets that the company owned. Yes, the insurance company eventually paid out, but the one thing that they did identify was maybe the client should review every year the fixed asset register for insurance renewal purposes to make sure there's nothing on there that should be on there. So hopefully that's answered the question.
I think it has, Stuart. Thank you very much. Okay, another question in from Hayden. Thanks, Hayden. I'm going to direct this one at Peter, if that's okay, Peter, because it relates to your session really on director loan accounts, and that's can the director charge interest back to the company for money injected into the company, and how would that be calculated?
Yeah, so the answer to that question is yes, they can. The directors can charge interest. Unlike the HMRC official rate where the company will charge interest, there is no official rate as to what interest to be charged. What we tend to do is look at what a market average rate would be for an unsecured loan, and that interest would be charged. The director would then need to report that interest, and they would need to pay tax on that interest as well as an individual.
Thanks very much, Peter. I hope that answers your question, Hayden. Again, use the Q&A if you want to follow up on that. Another question here, I'm going to direct this one at Christopher, if that's okay. Limited companies versus sole traders versus partnerships. In terms of company structure, which one is more tax efficient?
Okay, big question. First question the clients asked. But before I answer that, I'll just come back to Hayden's question, because it ties in nicely with what Stuart was chatting about earlier in terms of dividends and salaries. The interest you charge on a loan where you've invested money into the company is another way of extracting profit out. So it's part of that discussion about how you want to take money out of the company. And one of the extra advantages of the interest, just like salary, it's taxed as income, but there's no national insurance on the interest. So it's another variable to think about now you take money out of the business. Now, coming back to what type of business you have, there's a number of aspects to think about here, but I think the most fundamental thing is, clients probably worry about tax, but I think the most fundamental thing is limited liability, because a sole trader or a partnership is treated just as the same entity, it's the same person. So if something goes wrong in the business, it's that person who gets sued. And in the extreme case, go bust. It can be so dramatic. Whereas a limited company is a separate entity, and in its name, it is limited liability. It protects the shareholders who own that business from any liabilities. The liabilities stop with the company. So from an operational point of view, that's a very good way of protecting your personal wealth, especially if you're in a kind of risky business where it might be high risk whether it comes off or not. Or even employing staff, all the employment legislation around it. So I think that's the most fundamental thing to think about. There is a variation, actually. You can have a partnership which is a limited liability partnership, so that covers a limited liability question. So I think there are two options really to go with in most scenarios. And then it comes on to a question of tax. Partners in a limited liability partnership, just like a sole trader, will be taxed on any profits they make in that period. So if they make it, then pay tax on it. Where with a limited company, it's a bit more complicated. The company earns the money in the first place, pays the tax, and then there's a further aspect about how you extract the money out, and that's what Stuart was covering earlier. One extra advantage of that two-stage bit, you can decide which tax year you want to actually have that personal liability. If you're extracting money out, it might be a year where you want to avoid having a big tax liability. Maybe you've got some other source of income and you don't want to go into high rate tax. So it gives you a bit more flexibility. And then a final aspect of that tax is, given the rates on salaries and dividends, again, which Stuart was talking about, compared with a sole trader being taxed or a partner within a limited liability partnership, there's an advantage if you structure it correctly to have the salaries and dividends out of the company being lower tax liability. So that kind of drives you towards the limited company aspect. So they're all the good things. You've got limited liability, reduced tax. Just think something to bear in mind. There's a price in that if you've got a limited company, you've got to publish accounts online at company's house once a year. So that openness to some extent, and a little bit more time consuming putting the accounts together for a limited company. So there's a few more administrative costs. So a number of factors taken on board, but at the moment, I would say it favours a limited company, but it all determined by individual circumstances. The unfortunate thing is we don't know what the future is going to hold, so those tax rates might change, and then you probably only go on what the tax rates are at the moment. But there's that uncertainty in these decisions.
Okay.
If I could just butt in as well, a small point that I totally agree what Chris has said there, but my experience of a limited company where the limited liability is protected is all well and good as long as your client doesn't sign personal guarantees. And that's something you just need to tell clients or colleagues, that if you put a personal guarantee on a piece of plant, if the company hasn't got the funds, then they're going to come knocking on your door because you signed the personal guarantee. So it's a very good point to just make that, if someone says, look, I'm desperate to do this, I need to sign a personal guarantee, whatever you do, don't forget about it, because it might come back and haunt you one day.
Yeah, good point, Stuart. Thank you. Okay, we've got time for one more. I'm going to pick up this one that's coming from David. Thanks, David. If it becomes more attractive to have electric cars in the business, given the write-down benefits, would it be better to buy outright or lease the car? I'm going to push that one to Christopher, who's our company car expert. Do you know the answer?
I've got the hot topic today. Right then, I think the question here is forget about the aspects of the electric car, really. It's whether you buy or lease. If you buy, you've got an outlay straight away, and then at some stage in the future, you either sell it or trade it in, and so the cost is a difference between the two. Whereas a lease, you sign up and you have a lease for 2 years, 3 years, and you pay so much per month. So it's kind of more fixed. I know these leases can get quite exotic and complicated, but essentially it does clarify how much you're going to have to pay out of that three years, say. Whereas if you own the car, there's a bit of risk of what you actually will sell it for. So there's that aspect to think about. You mentioned in the question about the write-downs, and I mentioned the 100% allowances. That's very much a timing issue. I don't think that distorts the question about whether to buy or lease. And my experience of it is it's not straightforward, because the leasing companies quite often have incentives to actually push their products and come out with special incentives, a lower rate or something. So I think it comes down to the actual agreement you've been offered in terms of what those outlays over 3 years or 4 years or 2 years would be, compared with what your estimate would be, what you've got to buy for the vehicle, but the big estimate is what you actually would sell it for. And I've advised clients, if they don't feel confident negotiating with the car dealer, if they don't get a very good trading value, you might be better going with a lease option. But if you think you can get a real good bargain, you good at kind of haggling, buying might be a better option. But again, it all comes down to the actual lease you've been offered, because it can vary significantly. So okay. I don't think I've given a 100% answer to that. It's a bit grey, but it's a great subject.
Okay, well, I hope that answers your question, David. I'm sure anyone at Thomas Combs would be happy to pick up directly with you if you want to discuss that in a bit more detail. Well, that brings us to the end of our webinar. Thank you very much for all of the questions. Thanks very much for your involvement today. I just want to say thank you to Christopher, Peter and Stuart for your insights. Just as point of reference, we are adding a business owner FAQ hub onto our website in the next couple of days. The idea being that we can keep adding questions into that hub that are frequently asked, and I would suggest that's a good place to visit on a regular basis if you've got these types of questions, because you may well find the answers on there. And of course, anybody here at the practice will be delighted to talk to you at any time. As I said, we've got a recording going up on our website of this webinar and our social channels later on today. So thank you very much for attending. Thanks very much to our panelists, and I look forward to our next one.